the focus of this video is very simple to help you understand premium bond, discounted bond, and a bond which is at par. If you don't understand what a bond is, if we are looking at it from an investing point of view, we say it is a debt instrument. And in the simplest sense, we are assuming that we have a government that wants to build a project. Now, the government wants to raise money, the government wants to raise capital to build a project. So the government can issue bonds to the general public. All right. So the government, let's say, is soliciting for funds or for capital for the project. The point here, as I said earlier, bond is debt. So you, the provider, the one buying the bond or the debt provider, you expect to get your money back at the end of the contract. This is not shares. You're not becoming a shareholder in any company. So you expect to get your money back at the end of the contract. So the government gives you a contract, which is known as an indenture, that captures the whole bond agreement. Now, on this indenture, the government promises to pay you an interest at the end of every year. Let's say 5%. The government states the duration of the contract, let's say 5 years. And most importantly, the indenture captures what is known as the face value or the par value of the bond. Now, the face value or the par value, let's make this 1,000. This is how much the government is promising to pay you at the end of the contract. This one is debt, so you expect to get your money back at the end of the contract. Before you buy it, you already know how much the government is willing to pay you. So he's willing to pay you $1,000 at the end of the contract. So this is one way to say that the government is determining the value or the market price of the bond, which is what, 1,000, because he is going to pay you 1,000 at the end of the contract. So what it means is that give me 1,000 and I'm going to pay you 1,000. As simple as that. So in addition to the 1,000 is the coupon payment. So these interests are also known as coupon. So interest rate is the coupon rate, which is 5%. So 5% of this is going to be 50, right? 50 every year. So this $50 is what coupon payment that you are going to make at the end of every year. This is year 0. This is when you buy the bond. Year 5. The government is going to give you the 5% at the end of the 5th year plus your $1,000. So what it means is that you also simply give the government 1,000. All right. So this is the price of the bond. You pay 1,000, the government gives you the 1,000 plus your coupon payment at the end of it. But what happens is that sometimes before you get access to this bond, all right, the price of the bond in the market is 800. Means it has come down to 800, or sometimes it could be selling for 1,200 in the market. So here, if you pay 800, you are paying 800 and the face value does not change. The government is still going to give you the 1,000. If you bought the bond for 1,200, it still doesn't change the face value. You are still going to get 1,000 at the end of the contract. So when you are paying more for this, you are paying at a premium. And that is when we say the bond is a premium bond. When you are paying less than what is captured on the face value or in the indenture, the bond is a discounted bond. And when you are paying exactly how much the contract is going to give you at the end of the 5 years, then you are paying at par. All right. So the next session, we are going to understand what happens for you to be paying a premium fee, or to be paying premium for something that is less, or to be paying less for something that is more, and also why you are going to be paying exactly 100 for this. Let's move on to the next session. So we are still on our bond A that has been issued by the government. All right, so these are the features of the bond: 5% interest, duration is 5 years, and the par value, as we explained, is $1,000. The time you get access to buy this bond is not the first time that the government issued the bond. All right, so by the time you get access to buy this bond, you are likely operating in what is known as the secondary market. The first time that the government issues this bond, the new bond issuance is done in what is known as the primary market. But of course, as a retail investor or as an individual investor, you will not have access to the primary market because this is done by hedge funds, the big players like the banks, and insurance companies. So they have access to the primary market and they are going to deal directly with the government. So these people are the ones paying billions of dollars, pounds, whatever it is, to the government for the government to raise capital that it needs for the project. All right. So we are almost out of the primary market. Now, these guys are also investors. They are equally investors. So they will need a platform for them to work, to make money on their investment. So that is where the secondary market comes in. Now, this secondary market, what is known as the OTC, that is over the counter trades. Here we are talking about the bond dealers. Bond dealers, we are talking about bond brokers and all those guys. All right. So the first time we are getting access to this bond, we are likely operating in the secondary market. Here, we are not even dealing with the government. We are not dealing with the government. We are dealing with investors. We are dealing with people who equally are seeking opportunities to maximize their profits. So what happens is that there is what? Constant buying and selling. Okay. Buying and selling of the same bond is happening a lot here. We get what is known as the price discovery. Price discovery simply means that, of course, there are so many factors that are going to come into play. We have demand and supply is coming into play here. The market interest rate, inflation expectation. So these guys are going to buy the bond at the par value, exactly how much the government is willing to trade for the bond. They are buying the bond at 1,000. So they have got a bond that is worth $1,000. So let's assume this bond A, which is now $1,000, which is owned by one of these guys, is facing a very terrible demand in the market. What do you think is going to happen? The price is going to fall. But if this bond, people think this bond is very good because the coupon rate is bigger. For example, the coupon rate could be bigger than the market rate or the interest rate at the prevailing time. All right. So which simply means that if you have some money to invest, let's say you also have $1,000 to invest. Okay. If you deposited that $1,000 in a bank, the bank was only going to get you 3% on your interest. But now these guys have got a bond that is trading at 5% interest. So this security is way better than you keeping your money at the bank. So you may want to go into the secondary market and buy this bond from these guys. So if the demand is high for this bond is going to move from the $1,000. That is where it is going to be 1,100. So when you go to the market, you are going to pay a premium. That means you are paying $100 extra for something that is still going to get you $1,000 at the end of the contract. I hope the point is clear here. Now, let's still use this same factor. Should demand and supply be very low on this bond, what it means is that nobody is going to go after this bond. All right, demand is going to be so low. Price discovery would mean that the bond will fall. It's going to go down, let's say 800. So that will be a case. Let's say the interest rate is very good. If you deposited your money at the bank is giving you 7%. So no one is going to go after this bond that is only paying 5%. I would just want to deposit my money at the bank and make my 7% profit. So demand is going to fall for this bond. Price is going to fall. And that is where we are going to buy this bond at a discount. So the bond is going to fall to 100. Now, all things being equal, let's say all the factors here, nothing is really changing. All right. Interest rates, the market interest rate is also at 5. Nothing is really pushing people to go after this bond. So this bond is still going to be 1,000 on the market. So here, this 1,000 here is the same as the 1,000 you are going to get at the end of the contract. So at this point, we say the bond is at par. Now, in the next section, we are going to explain why someone would be forced to buy a bond that is 800, all right, which is going to give the person 1,000 at the end of the contract, and also why someone would want to pay premium. You are going to pay so much more for something that is quite little in the next section. I hope this part is also very clear. So this is the last section of our video, and we are trying to understand why someone would want to buy a bond at a premium. Why would you want to pay more for something that has promised or is promising to pay you less at the end of the contract? So premium. Now, assuming you have $1,000 and you want to invest, you have two options. One is to deposit your money at the bank and the bank interest rate at 3% for a period of 5 years. Okay, now the next one is to buy a famous bond A that is promising you 5% also for the period of 5 years. So a very quick math will demonstrate that at the bank we are going to make our 1,000 times 0.03. That's the interest rate for 5 years. Okay, so we are making $150 at the end of the 5 years. All right, now let's look at our option under the bond. The same principle here, we are promised 5%, right, for 5 years. Here we are making 50, so we are making 250. Okay, now because this is a better option, there's going to be high demand on this, and that is going to increase the price for this bond. All right, so the bond that is at par for 100, let's say, is going to be it's at par for 1,000. Sorry, it's at par for 1,000. It's going to be 1,150. So we are paying $50 more. So $50 premium for something that's giving us $1,000 at the end of the day. So let's look at our profit under the bond, which is 250. Even if we subtract the premium that we pay, we are still getting $200, which is still better than what we would have got under the bank option. All right, so instead of people just depositing their money here, they would rather want to go to the secondary market and pay more for a bond that has got a par value of 1,000, and this is your motivation for buying a bond for a premium. Right now, let's look at why would anyone be motivated to buy a bond at a discounted rate. So we still have the same option. We have our $1,000 to invest. We still have the same option, either to deposit the money at the bank. This time around, the bank is giving us 7% interest for 5 years, which is very good. Our bond is still giving us 5%, okay, for 5 years. All right, if you have 1,000, you may want to deposit that money with the bank because you're getting 7%. So you wouldn't want to buy this. All right, so let's look at 1,000 times 0.7, okay, times 5. So this is 70. So this is going to give us 350 at the end of the 5 years. So this is the bank. Now let's look at the option under the bond. So this is 50. This is going to give us 200. So at the end of 5 years, you are going to make more money to depositing your money at the bank. It wouldn't make sense to do that. So the demand rather is going to go for the bank. People are going to deposit their money here, which is going to make the price of our bond fall below the par value. So the price of our bond is going to fall to, let's say, from 1,000, all right, to let's say 850. Now this is the first, inspiration for someone to want to buy a bond, all right, because at the end of the contract, it is still going to pay you the 1,000. The par value doesn't change. So someone could easily say that, well, I'm paying 850 for a bond that's going to pay me 1,000 at the end of the 5 years. So it doesn't matter. Now, if you do it this way, if you buy this bond, you'd realize that at the end of the 5 years, your interest is not just going to be this. It's going to be this plus the discount that you got. So 1,000 minus 850. So this is going to give you 150. All right. So this 150 plus your 250, the 250 you made here, which is going to give you 400. So at the end of the day, if you bought this discounted bond, you are going to make $50 more than if you had invested your money with a bank. All right, so this now becomes a better option, and it depends on the multiplier. If you have a lot of bonds, $50 on each of them is a lot of money. So this is why anyone may want to consider going for a discounted bond. Now the last one is at par, right? At par simply means that you are paying 1,000 today. For the bond, at the end of the day, you are going to get 1,000, right? So this is where there are not really so much incentive whether to buy the bond or not. So here, the market price is the same as how much you're going to get. And I don't think we need an example for this. So this is the end of our video on explaining premium discounted bond and a bond at par. Thank you very much for watching this video. And we would appreciate it if you can support our channel by liking, sharing this video, and subscribing for more valuable content like this. My name is Paddy, and I'll see you in the next video.